Hi folks, and welcome to the Meaningful Money Podcast. This is Season 16, Episode 8. This is the podcast dedicated to helping you put your finances in order. My name is Pete Matthew, and I'm going to share with you everything you need to know and everything you need to do to secure your financial future. I'm here to help you make sense of money. Here we are once again. Thank you so much for joining me. Hope you're all bearing up and staying safe. Meaningful Money continues to be brought to you to hopefully provide some kind of normality and routine. There's lots of these episodes and lots of YouTube videos to watch if you're killing time at home right now. But thank you for joining me once again. Now, you've spent 40 years, maybe, if you're in the run into retirement. You've saved and invested towards that retirement. And in that time, you've got pretty good at putting together and maintaining an investment portfolio. And so that'll just pretty much carry on into retirement, right? Well, not so fast, because we're going to go deep today into investing for longevity, which is crucially important in retirement. So after the main body of the show, I'm going to read a review that's been left, talk about what we're going to be discussing next week. But before any of that, remember, this podcast continues to be brought to you by my good friends at Seven Investment Management. They've been sponsoring me here now since the spring of 2011, and I really could not have built this to what it is without them. So please do check them out and say thank you. They're at 7im.co.uk. That's the number 7im.co.uk. Go check them out. You see, investing in retirement requires quite a lot more nuance than when you're just going all out for growth. Why is that the case? Well, now you're most likely drawing down from your portfolio. So you're looking now for a balance of growth and downside protection in order to make sure that you avoid what is really the worst possible outcome, which is outliving your money, right? Can't imagine much worse than that. So as we dive in, remember, notes and links. There's quite a lot of links this week, actually. They're all at the show notes. And if you're out and about, this is the only link you need to remember. If you can't write this down, listen close. meaningfulmoney.tv/HS8. That's for Home Straight, Episode 8. meaningfulmoney.tv/HS8. Here's everything you need to know. Okay, first thing is that pound cost averaging can work against you in decumulation. And I'm going to continue using that word because I like it. Most wealth builders know and understand the principle of pound cost averaging. So this is where you're paying into an investment regularly. You're buying shares in whatever it is that you're investing into at different prices each month, say. So when prices are low, you buy more shares for your fixed monthly contribution. When prices rise again, you'll obviously buy fewer shares, but the ones that you bought more cheaply will have risen. And overall, that has the effect of smoothing the ups and downs of the share price over time. But of course, now you're thinking about doing the opposite. You're not buying in, you're selling out of your investments each month, or at least you could be, maybe. We're going to be talking about not doing this shortly, actually, right? So if that is what you're thinking, then hopefully I'm going to sort of change your mind a little bit on that. So this has a similar smoothing effect, just in reverse, and it does do that. It sounds logical, that, but the issue with it is that you don't really want to be selling out of investments when they're down, even, ideally, only a month at a time. Every share sold to cover your income needs while markets are down is a share which cannot recover when markets rise again, and they always do, remember. So the impact on your overall portfolio is magnified, and you might have heard this called pound cost ravaging, which is an appropriately violent sounding word to describe what's going on. So the impact of this can be profound if A, you're drawing out a large amount expressed as a percentage of the whole portfolio, and B, the downturn is prolonged. Now, we've all heard about the so-called 4% rule, which is actually a rule of thumb, not a hard and fast rule. And so let's say you have a portfolio with a value of 100,000, say, and you're taking out 4%, which is £4,000. Good maths, Pete. Now, let's say there's a market decline of 35%, much like the one we're currently experiencing. And so your £100,000 investment pot becomes £65,000. Now, £4,000 income as a percentage of 65 grand is a 6.2% withdrawal rate, which is punchy, to say the least. 16 years and the money's gone, not 25. So we'll talk later about managing your income needs, but if you are dependent on having that £4,000 to maintain a basic standard of living, and if the markets stay low for a year or 3, then you might be in trouble. Okay, so hold that thought as we go along here now. Secondly, managing costs is more important than ever in retirement. Remember also, anything being taken from your portfolio is potentially having the same effect as you taking your income out every month, and that of course includes tax and costs. Now, pensions, of course, are taxable when they pay out to you, so there's not a whole lot that you can do there. You might be able to use personal allowances and take some of a pension tax-free, depending on your other sources of income. 20% tax is better than 40% tax, of course, so avoiding higher rate income tax makes sense if possible. But then you've got platform costs, drawdown review costs, fund management charges, advisor charges. They're all taking a chunk out of your portfolio. So make sure you're getting value at each level and try to keep those costs as low as you can. It's common sense, really, but it's especially important, I think, once you're drawing down from your accumulated wealth rather than adding to it. Thirdly, crucially, before we go into the practical stuff, you've got to remember your levers, right? There are loads of things that we can't control in life and in wealth. I was not planning to potentially be working from home for the next few weeks, but it turns out that I might be just because somebody in Wuhan turned to his wife and said, you know what, I really fancy some bat for tea tonight. So you can't control a lot of stuff, but you can control costs. And as we just mentioned, you can control the investment mix of your portfolio. You can control your spending. And as ever, these are the things to focus all your intention on. You can largely ignore markets. They ignore you after all. They don't care about your precious retirement timeline. Instead, be prepared for whatever they might throw at you. Okay, so let's look at how to be prepared, right now. Let's have a look at what you need to do. Okay, here's the practical stuff. What you're going to need to do when you're planning your investing in retirement is to build a cash flow ladder. Now, if you haven't already, listen back to my conversation with Abraham Okusanya from that's about 4 years ago now about investing in retirement. I'll make sure there's a link in the notes. Abraham is something of a national expert in this whole area, and his book, which is called Beyond the 4% Rule, is well worth a read. I'll link both in the notes. Now, having read that book and some of the academic studies that he describes in it, I've arrived at what I think is an effective way of setting up a portfolio longevity. I've arrived. It sounds like I came up with it. Basically, it's derived from Abraham's sterling work and all the people that he references. But this is how we work at Jackson's. Setting things up so that your portfolio can cope no matter what markets throw at you. And I call it the cash flow ladder, which is, I should probably see if that's copyrighted actually, but I bet you Kiyosaki's done it already. Long-time listeners will have heard me talk about Risk Flex before, and I explained that in a 5-Minute Friday video from a year or so ago. And Risk Flex is the basis of the cash flow ladder. So your starting point is your fundamental overall attitude to risk. And that then informs your neutral investment approach. Now, if you haven't already, you can take a free questionnaire on the Standard Life website. There's a link in the notes to that. It's pretty good, actually. It's put together by the Oxford Risk people, so it's definitely not just thrown together. It's based on some pretty good science and psychology. There's also some stuff on the Money Advice Service website if you're new to this. And if you really want to take risk tolerance and behavioral finance to the next level, you're looking for the Beam app from my multiple-time guest, Neil Bage. It's iOS only for now, should be out on Android and hopefully a web version too in June, July time. But once you have a baseline attitude to risk, that now is your starting point. And the idea of your cash flow ladder is that your shorter-term needs are invested in a lower risk way than the money you're going to need in the more distant future. It's not rocket science, really, is it? If you're not going to need the money for ages, you can risk it. If you need it in the shorter term, you shouldn't. Now, I like to put together 4 levels on the ladder, okay, based on the time to when you're going to need the money. So really 4 levels. First 2 years should be held in cash. Years 3 to 5 should be invested a notch or 2 down from your baseline risk tolerance. Years 6 to 10 invested in line with your attitude to risk. Year 11 onwards can be invested higher than maybe your standard attitude to risk. Now, the rationale for those timelines and those risk profiles goes like this. So 2 years in cash first. There's been quite a bit of research from various quarters about how long it takes for a portfolio to get back above water after a market decline. Obviously, there's loads of variables here, not least the makeup of the portfolio. But my sponsors, 7IM, tested their own portfolios, and they found that their balanced portfolio, which is very roughly 50-50 equities, and with, 50% equities, 50% bonds and other stuff, that recovered within 12 months, 87% of the time. And it fully recovered back head above water, back to where it was at the previous high point, within 24 months, 97% of the time. So flipping that around, it took more than 2 years to recover, only 3% of the time. Okay? Now, for a more growth portfolio, call it a 70-30 split in favor of equities, the figures were a recovery within 12 months, 81% of the time, and a recovery within 24 months, 95% of the time. So the logic follows then that holding 2 years worth of your withdrawal needs, your spending needs in cash, should mean that in all but the rarest of cases, you shouldn't need to draw down from your invested pot while it is down. Simple logic, right? Years 3 to 5, that's definitely on the short side of an acceptable investing timeline. So if you're going to be investing money that you're going to need on that time scale, you should definitely err on the safer side of your risk profile. Now, I'm not going to go suggesting asset allocations. That would be far over the other side of the line called advice, right? So I'm not going to say, well, you should keep no more than X% in equities. There's just no hard and fast rules, and I could probably get in trouble. But if we accept that equities are the primary growth engine and also the main driver of volatility in portfolios, then it follows that to keep volatility and the depth of portfolio drops to a minimum, you're going to want to temper your equity exposure in the shorter term stuff. Now, years 6 to 10, this is sort of mid-range investing, if you like. And because of that, it can be done largely in line with whatever your standard attitude to risk is. So if you're a balanced investor, you can build a balanced portfolio. This should be fine because you know it's going to run for at least 5 or 6 years. Years 11 plus. Now, given this is so far out, I think you can definitely afford to ratchet things up a bit here. So maybe build a portfolio for this rung of the ladder, which is a notch or two above how you would normally invest. So if you're a balanced investor, you could take that up perhaps to a moderately adventurous type portfolio, increase your equity percentage a bit. Now, note that this is independent of tax wrapper. So you could have elements from each rung in the ladder in both your pension and your ISA, for example. You might be able to achieve this using sub-accounts if your platform allows you to have different sort of segregated pots within one pension, say, or an easier way is to just achieve it with funds, okay? But the idea is then that once a year, you reassess the makeup of your overall portfolio in line with A, the prevailing market conditions at the time, and B, the fact that you're a year further on. And what happens is that money essentially moves down the ladder and closer to you as you need to spend it, and down the risk scale as you need to spend it. So it's quite logical, I think. Maybe it's my mind, but I think it's logical. Now, as I record this, markets are super volatile due to the impact of the whole coronavirus shenanigans. So I'm getting loads of emails and posts in the Facebook group where people are saying that they're sanguine, really, about the volatility. Why? Because they don't need to access the money yet. And that is the crucial point. Using the ladder, you know that you shouldn't need to access invested money for at least 2 years because you've got that in cash. Make sense? So you can let markets recover, which they nearly always do within 2 years anyway. Okay. Number 2, use tax allowances where you can. Now, as I mentioned earlier on, in order to give your portfolio the very best chance of outlasting you, you're going to need to have a mind to minimizing the tax payable on it. Both ISAs and pensions are very tax efficient while the money is in there, so there's no issues there. As I said, you'll pay income tax on the way out of a pension, so make sure you're using every scrap of your personal allowance if it's not being used by other sources. If you've got money in an ISA, tax isn't an issue, so there's nothing to do there. Any interest you get on cash is tax-free for the first £1,000 a year or 500 quid if you're a high rate payer. Any dividend income is tax-free for the first £2,000 in any 1 year. So obviously, make sure your money is managed as tax efficiently as possible within your individual situation. Should go without saying, but I thought I'd say it anyway. Number 3, important, spend from bonds if you have to. Right, let's say you set up the cash flow ladder, just like I've described. You've got it all planned out nicely. And then for some reason, you need to lay your hands on 50 grand. And you weren't expecting to have to do so. That's kibosh things a bit, right? Now, you might find that hard to imagine ever happening, but you never know. And worse still, you need to get your hands on 50 grand while markets are down, right? In fact, actually, just as an aside, friend of the show and mega legend, J.L. Collins, still absolutely my favorite ever interview I've done here. He recently blogged about selling assets, even in the current climate, because firstly, there was capital gains reasons why that was quite advantageous, but mainly because he needed to buy a house, right? And he kind of wasn't expecting to have to do that just yet, and he needed to buy a house. So I'll make sure I put a link to the blog in the notes. Now, if you need to do this, so if you do need to disinvest money out of your portfolio, perhaps when you're not expecting to, then the best thinking, according to the studies that I've seen, is to take that money from bonds rather than equities. Now, the logic, of course, is that equities will be the asset class that recover most strongly when markets turn back north. So you want to hold on to those. Whereas bonds will probably, important word, have been shielded from the worst of the market declines. So selling out of those won't be so damaging. Of course, not all bonds are created equal, right? So I imagine if you can, you'd probably want this to be from developed government bonds rather than corporate or high yield bonds, which can be pretty vulnerable in market declines. So if you've built your own portfolio of tracker funds in each asset class, it's easy to sell down just bonds. You just sell down those funds, right? But if you're in a kind of off-the-shelf multi-asset fund, you're not going to be able to separate out your bond holdings. You'll just have to sell shares in your multi-asset fund and will, in so doing, sell down some equities as well. But you can fix that by understanding what your equity bond mix was before the sale and then adjusting for the fact that you'll have had to sell down some equity allocation by rebalancing afterwards and maybe adding a pure equity tracker to compensate. So, for example, always worth putting an example if we can, when we're starting to talk numbers like this. Let's say you've got 200,000 in an exactly 50% equity bond split, and it's in a multi-asset fund. So you can't determine whether you sell down equities or bonds. You just got to sell this fund that you're in. And you've got to sell down 50 grand, okay? Now, what's left is still 50-50, of course. There's 150 grand left. It's in a multi-asset fund, and it's 50-50. So you've got 75 grand now, essentially, in each asset class. But if you had been able to sell out of bonds, you would have been left with 100 grand of equities and 50 grand of bonds. And that would have been a 66-34 split, roughly. So in order to arrive back at that split, you're going to need to work out how much to switch out of your 50-50 multi-asset fund and maybe into an equity-only tracker so that you can recreate the 66-34 split. In case you're interested, the answer in this case is about 48 grand. Now, that means you're now in a much riskier portfolio than you were, and potentially riskier than you were otherwise comfortable with, because you used to be in 50-50. You've taken some money out of your bond holdings, so now you're 2/3, 1/3 in equity. So it's now very much a growth portfolio. You might not be comfortable with that. So you can either just accept the fact that fate has dictated that you sell out of your multi-asset fund when you'd really rather not, take a deep sigh and move on, or you can do something about it and maybe adjust accordingly. Okay? Up to you. Now, the fourth thing you need to do is to work 1 year at a time. When you're spending from capital, reviewing progress and being intentional about your moves is really an annual process, right? You can really do it in one shortish session, a couple of hours maybe, once a year, and then just keep an eye on things in between times. So at review, you need to be asking the following. What was my spending like last year? Was it more or less than I thought? What do I see I need to spend in the coming year? Is it more or less than last year? Are there any one-offs that I need to think about? All right, so spending first. How is the portfolio placed right now? And as a result of that, should I rebalance things? Do I move money down the ladder? Or do I wait maybe a little while if current markets are very volatile? The benefit of leaving 2 years' worth of money in cash is that hopefully you should be able to see out any market dips, right? It's theory. Who knows in practice whether it will really always be the case. But for the most part, in the vast majority of cases, you should not have to do too much damage to your invested portfolio, all things being equal. So should you rebalance things now, move money down the ladder, or wait if things are very volatile? Try to think these things through. Make the decisions you need to make and execute the portfolio changes. And then you're done. All right, get on with your year and review it a year's time. Finally, really, really important. Part of that review process will be to take an adult approach to your spending. If your portfolio has taken a battering, it might just be that you're going to need to rein in your spending next year a little bit. That's not the end of the world. It's the adult thing to do. Maybe you'd hoped to make a big purchase on something, right, next year. But you can see now that in order to do that, you might have to ravage your portfolio at a time when you really don't want to do that. So weigh up the two. Can you just wait a while to make your big purchase, to go on that big holiday, and in so doing, give your portfolio a chance to recover? That's the adult thing to do. And I'm always encouraged that the skills and disciplines that get people into the position where they can afford to retire don't just desert them when they finally do retire, when they finally do get there. You know, if you can make adjustments to spend less when the market is down, notwithstanding the 2 years in cash and everything, then that will serve you very, very well. So I hope that's helpful. Sometimes things are difficult to explain in a podcast, you know, rebalancing and 66-34 splits and stuff. But actually, this is very simple. The cash flow ladder provides some protection and is based on evidence of time for market recovery. Taking care over your asset allocation, and particularly from which assets you draw if you do need any ad hoc lump sums, that can have a big impact on the longevity of your portfolio. Doing the simple things like having a mind to costs and tax also will help. And as ever, the message is to be intentional with annual reviews and spending patterns to give yourself the best chance of always having some money behind you. Hope that's useful. Okay, podcast this week titled Fantastic Podcast, Genuine Person. It's true, I am genuine. Look, I'm squishy and real. And this is from JJ Bry 92. Meaningful Money is hosted by Pete Matthew, delivers brilliantly presented, easy to understand episodes. Pete consistently mentions that his goal is to help people by spreading solid financial information and advice to the masses. He fully backs this claim up by taking an active role in interacting with and supporting his listeners in spite of his mounting workload. I've been fortunate to have my own interaction with Pete, and the man could well have helped change my entire career outlook. Watch this space. Thank you, Pete. From Josh. Thank you, Josh. You know, I will do everything I can to maintain my ability to correspond and answer email and stuff. Obviously, it's getting busier and busier, but I do what I can, and I'm so grateful to everybody who does send me emails. Currently, I think I respond to everyone. If I've missed you, then let me know. Sometimes things get filtered and end up in spam or whatever, but you know, I do my best to do that. I think it's really important, and particularly right now. So thank you, Josh, for that review. If you want to do the same, please do. It really helps me out. meaningfulmoney.tv/iTunes if you're of an Apple persuasion, but wherever you're listening to this, if you can leave a review, please do. It helps others to hear about the show and to subscribe because it keeps me near the top of the rankings. Now, if you didn't catch my special episode with Neil Bage of BIQ late last week, definitely check that out. We covered off the normal human response to what's happening right now, how to respond in a measured way, and then we covered the importance of trusted friends and advisors to help us navigate these very uncharted waters. Arguably, it's the most important session that I've done in a long time, and so listen to that if you haven't already. Some of you in the group have asked about fast-tracking Meaningful Academy, which is still being built, just so that you can have something to do while you're self-isolating. We are working hard on it, but it's not ready yet, and I don't want to rush something out that I'm not proud of. That said, I'm going to have a bit more time on my hands too, so I'll be making the best use of that to try and get the Academy stuff complete as soon as I can. Right, next time we're going to be talking about optimizing retirement, the decisions that you're going to need to make around position of your portfolio, the way you spend money, lots more besides that. Okay, so that is it for... There you go. Didn't know I'd triggered the music or not there. That's it for this week. Hope you enjoyed it. Links, there's lots of links as you remember this week. meaningfulmoney.tv/HS8. Thank you so much for listening, folks. I hope you enjoyed it. Stay safe, hang in there, and I'll speak to you soon. Cheers.